Nvidia shares fell today after yesterday's failed breakout attempt right before earnings, Netflix attempting its own trend breakout after backing out of the deal for Warner Brothers Discovery, and the S&P 500 continues stagnating between two major gamma exposure concentrations, the 6,800 level on the downside and that big gamma exposure at the 7,000 on the upside. We're going to get into all of that and more in today's video, but first let's start out by taking a look at small caps. We'll take a look at IWM, the small caps ETF, bucking the trend today of 0.53%, closing at 265.99 in a very nice uptrend. You can see these parallel channels forming the basis of this uptrend since the end of November, and we've been holding those levels, and we actually have multiple confluences of support on small caps. This could be sector rotation as the tech-heavy NASDAQ continues to lag behind. Small caps continue to find support within this channel, and you can see just over the last couple of days, gamma exposure at higher strikes up to 270 has really been growing very strong, and we think there's a potential opportunity for further upside in the next few trading sessions. As part of one of our sub-strategies in our portfolio, we trade a weekly income strategy using IWM. Just yesterday, we locked in $1,100 profit on our short February 25th IWM 263 puts. We rolled those out, staying with the same strike, rolling those out to Friday's expiration, selling the February 27th IWM 263 puts. So today's move obviously saw a lot of premium get sucked out of those puts. We sold those for $1.32. So it's a potential $1,300 profit in just a couple of days, as long as we can hold above that 263 level. As always, we are hedged, and we are holding our long March 6 IWM 260 puts as that hedge, and we'll just continue selling that premium at 262, 263, and 264 as IWM continues trading within this zone. And you can easily see the divergence between small caps and how basically flipping over to the Qs here during the exact same time period, the Qs have gone nowhere, and in fact almost are forming a double top. Now we are holding these lows at 600. This is a very important level from our estimation. Most of the gamma exposure is between 600 and higher. However, there is a strong negative skew in the gamma exposure data, basically informing us that volatility is expanding in the tech-led QQQs, and that's something to be aware of as we are trading still below this 50-day EMA on the daily. Flipping over to the S&P 500, as I mentioned at the beginning of the video, we still have this large gamma exposure concentration at the 7,000 strike, and so even though we've been basically going nowhere on both the Qs and the S&P, I will say that at least there is continued magnetic effects at that 7,000 level. So every time that we've come down here near the 6,800 strike over the last 3 or 4 months, we've basically seen a buy the dip scenario with rallies pretty strong up into that 7,000 strike. And over the last few trading sessions, it's really been no different, despite the lower lows, lower highs candle that we saw in today's trading session. So we're still basically in no man's land between these major levels, and we're going to continue watching. One of the things that we pointed out last week, though, was that in entering the new March OPEX cycle, if we filter our gamma exposure data for this OPEX cycle that ends March 20th. So we're essentially filtering our data to only show contracts expiring between now and March 20th. And basically what this is telling us is most of the option contracts with all of this gamma exposure at the 7,000 strike expire in that March 20th expiration. So this is going to continue to be a magnetic force for the market. I expect further consolidation. We're past the bulk of earnings season now. And so this 7,000 strike is going to continue acting as a magnet, especially as long as the 6,750 to 6,800 level continues holding as support. Volatility is still a concern. However, our GEX weighted volatility gauge showing us that implied volatility on the S&P has been lower 79.6% of the time over the last year. So on a relative basis, volatility is extremely high, and so this combined with dancing around this negative gamma exposure level really makes for kind of a choppy, consolidating sideways environment. If we start seeing negative gamma exposure pick up, especially on the S&P, that could really swing things to the downside. So that's something that we're watching very closely. We're discussing this daily in our live stream as well as in our community Discord, which you guys can check out absolutely free. Links in the description below. We continue tracking Bitcoin. Bitcoin still has not broken those lows below that 60,000 level. It's actually been hanging on for dear life over the last 3 or 4 weeks throughout the month of February, consolidating in what looks to be a giant bear flag pattern. We see continued resistance from the 50-day EMA. That's been in place now for the last 3 or 4 months as well. Most of the gamma exposure over the last 3 or 4 weeks has been concentrated between 60,000 and 70,000, and that's basically just keeping price stuck in this zone. It does look like with rising volatility, negative gamma exposure, the potential for a breakdown below that 60,000 level is continuing to rise. And so while we may have some sort of attempt at mean reversion, this moving average is moving down quite rapidly, and that's going to continue to act as resistance for the foreseeable future. Turning next to Nvidia. Nvidia was down 5.46%, closing at 184.89 following its earnings report last night, actually beating on both the top line and the bottom line. EPS came in at $1.62. Revenue came in at $68.3 billion. Really a blowout quarter. Nvidia's projections continuing to look higher, although the guidance they gave last night was a little bit worse than the market expected. So in our view, Nvidia continues to trade within this zone. We talked about this failed breakout yesterday. Basically, Nvidia attempting to get above this 195 level, and with the big candle down during today's trading session, bringing it right back in this range that we've been in for the better part of the last 3 months. Most of the gamma exposure over the last 3 months has been concentrated between 175 and 195, and only just the last week has that slightly shifted to the upside, with market participants betting on a big blowout quarter. In fact, they kind of got that, but the stock just did not respond. We've been playing a lot of iron condors, as we've mentioned a number of times in our recent YouTube videos, and I think we're going to add another iron condor in our portfolio, focusing basically where the gamma exposure is concentrated, 180 on the downside and 200 on the upside. We think that is the likely trading range, and I think an iron condor would be a great way to capture some premium if price continues trading range bound over the next few weeks. Next, let's take a look at Netflix, and Netflix has really had a difficult time over the last 7 or 8 months, trading from the highs above 130, getting cut nearly in half, getting into the mid 70s as of just a couple of days ago. But with this news that the Warner Brothers deal may be falling through, we're seeing a pop in the stock back up to the 50-day EMA. I really want to see Netflix get above at least a couple of closes above that 50-day EMA. And according to the gamma exposure data and the options market, there's a potential for that to happen. We're starting to see volume coming in here at the 85 and the 90 strikes, basically everything in between. Big volume today, and then we're seeing the gamma exposure at the 90 strike as well as the 100 strike really starting to pop up here. So this might be an opportunity for a speculative out of the money call debit spread, basically using some risk capital to make a bet that Netflix is about to break out of its long-term downtrend that it's been in over the last several months. So if we can get at least 1 or 2 closes above that 50-day EMA, which is currently sitting at 86.75, I think that makes for a pretty decent setup on Netflix to potentially make a move towards that 100 strike. Of course, it's still in a headline-driven environment, but as we've seen, the decline has really not matched the overall fundamentals as we continue to see EPS and revenues estimates rise into 2027. And guys, our winter sale is wrapping up this weekend. You can get an additional $300 off our yearly portfolio manager tier subscription. Use code WINTER2026 at checkout. This discount obviously is going to be ending soon, so definitely take advantage of it while you can. Members get full access to our gamma exposure dashboard, our option flow analytics tools, as well as our algorithmic trading strategies. And you'll also get access to the premium channels in our community Discord. We've got a ton of great members in there sharing their own trade setups and strategies, and you can also track our trades in real time as we manage our options portfolio. So it's a great resource. Definitely check it out when you get a chance. Links in the description below. Thanks so much, everybody, for watching, and we'll see you guys in the next video.